What's poppin'? Oh my god, I almost fell off my chair. Jesus. Holy Toledo. Welcome to freaking Trey's Tutors, baby. This is going to be a series essentially on options, markets, and options, market makers. I'm going to kind of walk through a couple video segment here, talking about market makers. I want to talk about hedging. I want to talk about unhedging, gamma squeezing, just to fully walk everybody through this process so that it's completely comprehensible at a basic level. We're going to break down each individual segment into a different video. This piece is going to be focused on the options market makers and how that whole process works so you can have an understanding essentially of how the market works. I make this video primarily for AMC, but this applies to everything, right? The only reason I'm making this now is because there's a high demand for this education. I think it's important stuff to know. So, without further ado, what is up, everybody? Welcome to Trade Trades, where we can talk fast and don't skip class, baby. Like your brothers was saying, I'm not a financial advisor or expert, so take what I say they're going to sell. Let's get into the video. So, I've got kind of a 4-step process mapped out here. 1, 2, 3, 4. They're all color-coded to keep it nice and simple. A couple of terms that you're going to need to know, right? Hedging. What does this essentially mean? Well, hedging is essentially managing risk. When you hear about, maybe institutions hedging against their bet, it means maybe you're long on a stock, $5 million, and you hedge against that bet. Hedging meaning essentially managing risk and exposure by having a backup plan by playing puts for the downside so you can make back some of the losses on the long position if it weren't to pan out. That's hedging, right? It's managing risk. Important thing to know. Derivatives apply to the options market, right? So an option is a form of derivative. That's an important thing to know. Liquidity is just cash on hand, right? How much liquid capital do you have in any given moment in time so that you can manage essentially the entire, freaking financial body that the market makers do. So that's an important thing to talk about. So we're going to start off here with the actual options market makers. Now, what do? These guys essentially write up contracts, calls, puts, selling calls, selling puts, whatever it may be. There's a whole bunch of different variety of things. To keep this nice and simple, we're going to talk about buying calls and buying puts, right? Market makers are in charge of this entire process. They write up the entire options market, the derivatives market for institutions, retail investors, and even the market makers to buy and sell from, right? So this whole process, let's say, just to use AMC as an example, right? You look at the options chain, you can see that there's strike prices between $0.50 all the way up to $145. The actual options market is dependent on demand and what the market makers essentially deem as necessary given the current market conditions and given the demand of that given derivatives market, the options market, right? AMC recently went up to $145. This happened because the options on this trade extremely high. It takes up a large amount of the actual derivatives market in the U.S. stock market, right? They're in charge of that entire process. So now that you know that, market makers, options market makers, write up the options market, right? How does this actually feed into the entire supply and demand, right? The buyers and the sellers. Now, buyers and sellers can be a bunch of different people. It can be retail investors, it can be institutional investors, apes, the suits, whoever it may be, right? There's people that'll buy from the options market. But first, the actual market makers, once they write these contracts, have to put them on the market. Now, once these are on the market, it's free chicken for anybody, right? Including the actual market makers. Now, we're going to get to that here in just a second, but buyers and sellers will come into this options market and essentially have transactions. Every transaction has a buyer and a seller, and the majority of the time, it's going to be institutions and retail investors, right? But it also includes market makers. Now, let's just use an example, right? Looking at, if you were to buy a call, you've got a buyer of a call, maybe you've got a seller that wants to sell that call, right? They're up a significant amount of money. Maybe they just don't want to take on that risk anymore. You've got an out the money call, for example, if you're to look at, $60 today. If you were to play $60, all of a sudden it's trading at $56, and this guy says, I don't want to touch this risk anymore. He sells it, and you've got another trader out here who wants to buy that $60 call, even though it's trading at, $56. That's a transaction that takes place, right? These are buyers and sellers. They feed into the actual options market. Every buyer is a seller, every seller has a buyer. But sometimes there's not an actual buyer and seller that want to trade hands, right? Sometimes it's the opposite, and you need to speed up that transaction process, which is where the market makers come into the equation. They can actually buy and sell calls and puts as well. They have their own market maker portfolio to speed up transactions. Now, you might be thinking to yourself, that sounds oddly familiar. Oh, faster transactions. This is the best the market's ever been. They're talking about just plain securities, right? Underlying stock. I'm going to come back to that. But they actually have their own portfolio to help speed up transactions. Because if market makers didn't have this, right, you wouldn't have as fast of transactions. Sometimes you wouldn't be able to sell calls. Sometimes you wouldn't be able to sell puts, buy calls, buy puts, both directions, right? Market makers help speed up that process and allow for more overall transactions, right? So now that you know that there's buyers and sellers, institutions and retail investors, as well as the actual market makers who make up this actual options market, sounds like a freaking vested interest, but what do I know? That's not important, right? They've got their own portfolio. They manage that stuff. let's talk about how things actually pan out, right? So now that you know buyers and sellers, all these transactions take place in the options market, you've got this fourth step, which is if calls are exercised. And I want to talk about calls specifically, right? So what happens? Market makers are in charge of making sure, essentially, since they wrote up the contract, there's a contract that says, hey, I'm going to pay you this premium so that you eventually, if I decide to exercise, deliver the stock for this underlying option that I decided to buy, right? Market makers have to make that happen. They collect premium, which is how they actually make profit, right? I'm going to show you this right here. Profit comes from the premium that you get on these options contracts. If you look at this overall, options chain right here, you can see the premium is actually showed at the ask price, right? So if this ever ends up loading, 80 cents would have been the premium per share, which comes out to $80 since there's 100 shares per contract. That come out to $80 per contract, right? They make their money off the premium. So since there's a contract saying, okay, I will collect this money to deliver you this contract, they're also in charge of if they decide to exercise. They keep that premium and have to deliver stock. Where do the market makers get this stock from? They get it from the market. They buy and sell from the market. And fun fact, the buying and selling goes into their portfolio, right? Their market maker portfolio. They will do what's called hedging. Now, hedging is important because this is a term that we talked about here just a little bit ago. Hedging essentially affects the actual market price. It drives price up and it can drive price down through either hedging or unhedging. It happens in both directions, right? So, call options start running in the money. You've got out the money calls that start running in the money, and these market makers will hedge for those calls, right? And essentially just keep this in their portfolio until buyers decide, not sellers, because sellers won't have those contracts anymore, right? The buyers would, because they decided to hold it and not sell it. They decided to exercise it. They have to deliver that stock. What happens if they don't actually have that stock, right? What happens? Well, they will deliver something called an FTD, a failure to deliver. Now, this is essentially an IOU. It's synthetic. It does not exist. And this will happen if there's really high demand, but not a lot of supply, meaning the market makers might not actually have the underlying stock in their portfolio, and the actual market does not have the supply to buy those actual shares to deliver on call options that end up getting exercised because they expired in the money, right? You either A, deliver stock, or B, FTDs. So now you kind of understand this entire process, really, I think simplified in a good way. There's other pieces of this that, I could throw in here, but this is the basics of how it works. So that you understand how, market makers make the actual options market. I kind of want to give you some points that come into this, both good and bad, from market makers that run this options market. You got faster transaction speeds, right? This happens because they have their own market maker portfolio, which allows when there's not a buyer and a seller on the institution or the ape side, right, to pull from their portfolio and deliver, essentially transact between a buyer and a seller, right? It also can lead to higher percentage of naked contracts, meaning if market makers don't actually have the underlying contract and they can't get it from somebody, they can write up a naked contract. One that should not exist because either A, they don't have the stock available and they don't think they're going to be able to get it, or B, they don't have the liquidity available, right? The liquidity, right? There's a liquidity piece of this, collateral piece of this, which is where Robinhood ran into issues. They didn't have the liquidity to be able to deliver, which is why they supposedly took away the buy button, right? Naked contracts can 100% go up, and it's a way to leverage money for both institutions and retail calls and puts in both directions. Results in more FTDs. And I say this, this is an important piece, paper versus e-trading, right? Because this faster transaction time, I said I was going to come back to this, and here we are. Faster transaction times lead to more ability for corruption, fraudulence, and manipulation. Bad practice, right? Which leads to failure to deliver. It's 100% true. You've got the most availability in the world right now to be able to buy and sell in instants, right? You can do it on your phone in the blink of a freaking eye. But this leads to more situations for computers and people to make bad decisions, to either A, give out something that they don't have, or B, deliver something saying they're going to give something back in return when they can't actually do that. And that's a failure to deliver, right? It's an IOU stating, hey, look, I don't currently have the stock for this underlying exercise call option, so I'm going to deliver you an IOU. Sometimes they deliver on the stock and they destroy the IOUs. Sometimes they don't, right? It happens in both directions. You can see how it's not just institutions and hedgies that are really doing some damage here. It's a systemic issue. It's a fucking problem. It's bad, right? There's good things about the options market. Don't get me wrong. It's a great tool to make money if you understand it to a T, but there is some issues with it, and I think this is one of them, is failure to deliver and naked contracts, right? Computers versus people. This is a piece that I added in here because this works both ways. So market makers can actually use algorithms to hedge for call options when it runs in the money or out the money, both directions, hedge or unhedged. Meaning a hedge is a buy. You buy, stock, underlying stock from the market in order to have that stock available to deliver on call options if they run in the money and get exercised. You can unhedge the exact same way. And I'm going to actually make videos talking about this in more detail so that it's very easy to digest. But that, that's the exact opposite thing. Unhedging means that the stock that was in the money is now out the money, and they sell that stock back into the market. They don't keep it in their portfolio anymore, right? This can be by a person or it can be by a computer, right? Algorithms. Now, it's kind of funny because apes talk about high frequency trading and algorithm trading and some of the malpractices that can come from that entire process. And people don't ever talk about the options market being one of these processes. You want to see an example of hedging in both directions, right? To me, this is one of them. This is an example of hedging in both directions. Look at this, right? I don't know why my freaking Weeple does that. Here we go. This is unhedging. This is market makers that decided to sell stock back into the market because they don't any longer need that risk for the underlying stock. They don't need to hold it anymore because it's not currently in the money. There was a lot of call options on AMC today, as an example, 29,000 at 59 bucks and 30,000 at 60 bucks, and it broke underneath 60 bucks, which can lead to unhedging. Market makers that decide to sell underlying stock back into the market, right? So that's an example of unhedging. Hedging, if you want to look at 1 hour candles, this is an example of hedging. That's gamma squeezing, essentially. Hedging takes place when market makers have call options, and a lot of them that start running into money, they have to buy stock from the market in order to be able to, save their butts. And I'm gonna, like I said, get into this in a different video. But computers or people can be doing that, and that's also an underlying issue, right? So that's kind of the whole process of what an actual market maker is, an options market maker, I should say, right? And the entire talk through of that process. I know it might be a little bit confusing if you're new to the stock market. There's probably people in here who think this is maybe too dumbed down. There's a broad variety of experience levels out there, but hopefully it's provided you some value. There's going to be 2 more videos coming. Watch for them. It's going to be hedging and unhedging. I'm going to walk you through both of those processes for anybody that's curious, and I might end up making a 3rd one talking about actual gamma squeezing and what that is and how this can create this endless feedback loop. So blah, blah, blah. I know those people. Drop a like, share, subscribe, whatever you want to do, my friends. Catch you on the next one. Hope you guys got some value out of this. Much love, light taps, and peace.